You previously said that you won't be cutting rates at the rate that you raise them. Does this mean Canadians should not expect a cut next month, or do you plan to cut again in July?
Look, I think the message was pretty clear. We're going to be taking our interest rate decisions one meeting at a time. If the economy continues to evolve broadly as we had expected, if we continue to see inflation pressures easing, it is reasonable to expect that there will be further cuts in interest rates. But the timing of those cuts, or of any further cuts, are going to depend on incoming data and our assessment of what those data mean for the future path of inflation. Look, we are determined to get inflation back to the 2% target. At 2.7%, we're still above target. There are a number of risks that we're watching closely. So, the work's not done. We're going to be seeing how things evolve and taking our decisions one meeting at a time.
Let's go now to Promit Mukherjee from Reuters, please.
Thanks, Paul. Hi, Mr. Governor. I would like to again take it forward, that question. Considering that so far the data has shown that the inflation has been easing and it's going in the trajectory that you wanted. If it continues in that way and you will have more numbers in terms of GDP and job by July 24th, if that all continues the way you want it, do we see a rate cut in July?
I'll get to the going ahead, but let's just enjoy the moment for a bit. Let me just say a couple of key points about the rate decision today, and then I will come back to where we could be headed. But look, a couple key messages today. We've come a long way in the fight against inflation. Headline inflation has come down, our measures of underlying inflation have been easing, and growth has resumed again in the Canadian economy. The second key point is the economy has evolved broadly the economy has evolved broadly as we've expected in recent months, and that has increased our confidence that inflation will continue to move gradually back closer to the 2% target. So we decided at this meeting that monetary policy doesn't need to be as restrictive as it has been. And we lowered the policy rate by a quarter point. I know this is welcome news to many Canadians. I also know everybody wants to know, okay, where are we headed? That is going to depend how things evolve. What I can say is that if the economy continues to evolve broadly as we have expected, and we continue to see a broad easing in inflationary pressures, it is reasonable to expect further cuts in our policy rate. But, and I want to stress this, the timing of any further cuts is going to depend on incoming data. In particular, is going to depend on what those incoming data tell us about the most likely future path for inflation. We are determined to get inflation back to the 2% target. We know there can be some bumps along the way. There are a number of risks, which I highlighted in the opening statement, which we're watching closely. So what does all that mean? It means we're going to be taking it one meeting at a time.
Paul Vieira from the Wall Street Journal, please.
In testimony to lawmakers last month, you talked about how if there's going to be rate cuts, they would be done gradually, and you talked about that there are limits to Fed policy divergence. Why is the word gradually or cautiously in terms of describing further cuts? Why is that absent from the statement?
I think we're being pretty clear. We're going to take it one meeting at a time. When I was asked about the pace of cuts, I think the question was something along the lines, you raised rates very rapidly. What's the pace of cutting looked like? When we raised rates rapidly, we were in a situation where inflation had moved up very rapidly, and we needed to raise rates rapidly to control inflation and bring it down. The situation now is quite different, and our own forecast has inflation easing gradually back towards the 2% target. So what that suggests is that the future path of interest rates, while it's reasonable to expect further cuts if inflation continues to ease, given that it's likely to ease gradually, the path for interest rates likely to be gradual.
Let's go to Kevin Carmichael from The Logic, please.
Governor, you, the senior deputy governor, others at the Bank of Canada have been obviously doing a lot of work around the productivity crisis. You seem to have surrounded the lack of investment as one of the big issues behind that problem. To what extent has the higher for longer interest rate environment impeded investment in your view, and how will that factor into your decision on how quickly to bring down rates going forward?
Well, Kevin, as you know, the productivity problem we've had here is long-standing, has multiple factors. It's had multiple factors contributing to it. It'll take more than one thing to solve it. Interest rates, certainly right now, interest rates and inflation are both uncertainty factors that affect business investment. So, as we get inflation back to target, that'll remove that uncertainty. Interest rates, as the governor said, it's welcome news. We've been able to lower interest rates today. We'll take the next decisions as they come and see how that factors into investment.
Okay, let's come down here to Najud Almalise from Canadian Press, please.
Hi, Governor. Building on Paul's question about the limit on how much Canada can diverge from other countries in terms of interest rates, can you talk a little bit about what that limit looks like and what it means for Canada right now to be diverging from many of its peer countries?
So in Canada, we have our own currency. We have a flexible exchange rate. And what that means is that we can gear monetary policy to the needs of the Canadian economy. So we don't need to move lock and step with the Federal Reserve. Obviously, what happens in the United States has a big impact on our economy. The U.S. is the biggest source of Canadian imports. It's a major source of, it's a biggest source of Canadian exports. We also import a lot from the United States. Our financial markets are very integrated. So what happens in the United States certainly has an impact on Canada, and we take that into account when we develop our own forecasts, our own outlook. We take that into account when we take our monetary policy decisions. But we have our own currency, we have a flexible exchange rate, so that means that we can take decisions that are geared to what the Canadian economy needs. And our judgment today is that the Canadian economy doesn't need monetary policy as restrictive as it has been, and so we cut the policy rate by 25 basis points. There are limits to how far we can diverge from the United States, but we're not close to those limits, and I expect that we will continue to be able to get inflation back to target and run monetary policy in Canada within those.
Okay, next on my list I have Alicia Sikirska from Yahoo Finance. Please go ahead.
Thank you, Governor, for taking our questions. Can you take us through the bank's consideration in weighing this cut versus the potential risk it may have on the housing market and in accelerating shelter prices?
When we published our April monetary policy report, we were expecting some modest increase in house prices. That was ahead of this decision. We did then, and we continue to point out housing as a risk to our inflation forecast. So it's something we're going to continue to watch. Ultimately, what we target is inflation. We don't target any particular measure in the housing market or an interest rate, but it's clear there is some pent-up demand in the housing market. We'll see how it goes.
Okay, I'm going to come down here now to Mackenzie Gray from Global, please.
in the same vein on housing, 76% of Canadian mortgages are going to be up by 2026. How much does that play a decision when you're thinking about cutting or keeping rates where they are? And how concerned are you that broadly for an impact on the Canadian economy?
Yeah, I mean, we're talking a lot about the data that we look at when we make our decisions. We always look at how our decisions are going to affect Canadians, and certainly the mortgage market is a big part of that. Mortgages are one of the biggest interest sensitivities that Canadians have. So we're looking at the same data. The 76% is a number that OSFI put out. That's something we've been watching all along. We did a deep dive on this just a few weeks ago when we put out our financial stability report. And you'll remember in that report, we also pointed out the impact on renters. So, you know, we know mortgage, people holding mortgages are feeling the squeeze. We know there is concern about higher interest rates when they renew their mortgage. But the effect of the credit stress we see is also showing up in renters too. And, you know, that's really inflation as well as interest rates showing up. So what we can do to help that situation is get inflation back to target. We know Canadians with mortgages that are renewing will welcome this interest rate change. They would like to see further changes, further reductions in interest rate. As the governor said, it's reasonable to expect that if the economy continues to evolve as we expect it to, if we continue to see an easing in core and headline inflation. But the bottom line is we also need to get inflation back to target. We're determined to do that.
Okay, Randy Thantong from Bloomberg, please.
Hey, Governor, how concerned are you that slower population growth will change your assumptions for potential growth, and how does that affect your thinking?
We are expecting population growth to slow. It has been exceptionally strong. The government has announced a number of measures, particularly to slow the number of non-permanent residents coming into Canada. We built that into our April forecast. That announcement came out before the April forecast, so we have built in that path for population growth. Population growth affects both demand and supply in the economy. Obviously, if you've got more people coming into the economy, you've got more workers, they're adding to the labor force. That has eased the tightness we've seen in the labor market. Those newcomers to Canada, though, they also need to rent apartments. They need housing. That has put a lot of pressure on the housing market. So there are both demand and supply effects. As population slows, that should, and if the supply of housing can increase as demand comes down, that should help relieve some of the pressures we've seen in the labor market, in the housing market. And with the labor market coming into better balance, we've seen businesses are hiring. They're still hiring, but their hiring has slowed, and it's actually below population growth now, which has helped rebalance the labor market. But the labor market is reasonably balanced. So. We will be watching population growth carefully, and when we get to our July forecast, we will update our assumptions about population growth and feed that into our projection. But given that it affects both demand and supply, it's not going to probably swing the forecast dramatically.
Okay, next on my list I have Mark Rendell from the Globe and Mail. Please go ahead, Mark.
Thanks for taking the question. I'm wondering if you could talk a little bit about the trajectory you see for the economy over the next coming quarters, next year or so. Obviously, as was mentioned before, we have a lot of mortgage resets, quite sizable mortgage resets and payment shocks coming up. Are we through the worst of it? Is there still a possibility for a recession going forward?
Well, as you know, we don't have an updated forecast at this policy decision. We run our forecasts 4 times a year with the national accounts. We will have a new forecast in July. But we did receive, obviously, the national accounts for the first quarter recently. And so growth in the first quarter at 1.7% was weaker than we'd forecast in our April monetary policy report. At the time, we forecast 2.8%. I guess what I would stress is that if you look at last year, certainly the second half of last year, the economy was really quite weak. GDP growth roughly zero through the second half. On per capita terms, consumption was actually declining. In other words, households were reducing, individual households were reducing their spending. In the fourth quarter and in the first quarter, consumption growth was about 3%. It's broadly in line with population growth. So what that means is that, per capita basis, consumption was roughly flat. So you're seeing some strengthening in consumption growth. In the first quarter, you also saw investment picked up a bit. Housing market has not been particularly strong, but it was positive. So growth has resumed in the first quarter. We'll certainly be looking at our growth trajectory going forward. But, to get back to your soft landing question, yes, so far it is looking like a soft landing. The plane hasn't been landed yet, so we're not cheering yet. But, I would say the runway's in sight. But, we still need to land this.
Okay, Greg Quinn from Market News. You're next, please.
Good morning. I want to ask about growth in the other sense, because the statement mentions the idea that there's room for growth in the economy even with inflation slows. I mean, that's a nice scenario. How big is that crawl space? Do we have a substantial amount of room to grow from here without sparking new inflation pressure?
Well, to go back to the previous question, so with growth roughly zero in the second half of last year, excess supply opened up in the economy. And that's actually been key to relieving price pressures. It's been an important reason why we're seeing inflation and underlying inflation come down. With some excess supply in the economy, what that means is there's room for the economy to grow. In fact, there's even room for the economy to grow faster than potential for a period, even as there is still downward pressure on inflation. So, we will be revising our forecast in July. I don't have a new forecast for you today, but I think what we're seeing in the first quarter, our growth has resumed. I think we expect over the course of the year, we expect household spending to gradually strengthen. And our message really is, given that the economy is in excess supply, there is room for the economy to grow, even as inflation keeps coming back down closer to the target. And, so to get back to our decision today, why did we conclude that monetary policy doesn't need to be as restrictive? Well, an important reason is just looking at inflation itself, core inflation, our various measures of underlying inflation. Since the start of the year, they've all been moving in the right direction. The fact that the economy is in excess supply, though, is another element that is giving us confidence that, even as the economy even as growth resumes, inflation can keep moving back towards the 2% target.
Okay, our final question in the room here goes to Daiichi Mishima from Nikkei News Service.
This is Daiichi Mishima with the Nikkei. Thank you for taking our questions, Governor Macklem. While you decided to cut rates, you also decided to continue quantitative tightening. It seems to me that you're stepping on the gas and brake pedals at the same time. So how do you determine when to stop QT? What are the conditions for that? Thank you.
Well, I don't see it quite the way you see it. The way we see it is we're normalizing our balance sheet. And as long as, let me put it this, we've gone through this before, but I'll go through it again. Yes, we reduced our policy rate today by 25 basis points, but at the policy rate of 4 3/4, monetary policy remains restrictive. And in fact, with inflation at 2.7%, underlying inflation roughly 2 3/4%, we still need restrictive monetary policy. There is still some work to do to get inflation back to target. It doesn't need to be as restrictive, but we still need restrictive monetary policy. And in that sense, continuing QT, continuing to normalize our balance sheet makes sense. If we were to lower interest rates so much that we're actually trying to provide stimulus to the economy, that would be a different situation. And in that situation, we probably would stop QT because, and then they would be working at cross purposes. But that's not the situation we're in now. With respect to the path for our balance sheet going forward, we have been letting maturing bonds roll off our balance sheet. Our balance sheet has been steadily shrinking. We will get to a point where our balance sheet is normalized, and at that point we will resume our normal operations and QT resume normal operations and begin buying government debt once again. As Tony Gravel has outlined certainly in speeches, that'll probably happen sometime next year. And we will provide, as we get closer to that point, there is some uncertainty exactly where that point's going to be. As we start to get closer to that, as we hone in on what the steady state level of settlement balances needs to be, we will provide markets update on that.
Okay, that's it for the room. We're going to go to those reporters who have joined us remotely. I'm going to just remind people on the line, please come off mute only to ask your question, then go back on mute as soon as you have finished so everyone can hear the response. I'm going to start with John Ehrlichman from Bloomberg BNN. John, please go ahead.
Thanks so much. Governor, I just wanted to see if you could shed some light on how you think about the level of our dollar, the currency, the relationship with the U.S. currency, and this idea of us importing inflation if we see more weakness in the loonie. And also, since you haven't been asked and the senior deputy governor haven't been asked about your pin so far, what happens to the Canadian economy if the Edmonton Oilers win the Stanley Cup?
Well, let's hope, Canadian team, let's hope the Oilers win the Stanley Cup. Go Oilers. The Canadian dollar. As I said previously, we have a flexible exchange rate. And one of the ways monetary policy works is it works through the flexible exchange rate. And it's the flexible exchange rate that gives us the ability to set interest rates in Canada that are geared to the needs of the Canadian economy. So, we don't have a target for the exchange rate. We have a target for inflation. We believe in flexible exchange rates. And I think by being clear about our forecast, being clear about what's on our mind, by doing these press conferences, by publishing the monetary policy report, by providing a summary of deliberations, I think markets have a very good idea of what's on our mind, and that's going to be reflected in the expected future interest rates. That's going to be expected in the exchange rate. That's monetary policy working.
Okay, next on the list, I've got Max Sato from Mace News. Max, please go ahead.
Thank you, Paul. Governor, leading up to today's rate cut decision, was there any discussion among the governing council members as to how this could affect the value of the Canadian dollar and import costs, or how the policy difference with other major central banks could affect the real economy?
Yeah, we discussed all those things. Of course we did. As I said, with respect to the exchange rate, yeah, it's one of the ways monetary policy works. And yes, we have been assessing the impact of higher interest rates on Canadian households, on Canadian businesses, and we know it's been difficult. We know it's squeezed households and businesses. That has relieved price pressures in Canada, and we came to the conclusion of this meeting that monetary policy doesn't need to be as restrictive as it has been, so we lowered the policy rate. So yes, those are the things that we're looking at.
Maybe I'll add, I mean, if you think about this past run-up in inflation, in the early days, a lot of what was going on was global. So there was commodity prices, there was supply chain impacts, and so central banks across the globe were acting sort of in concert. We were doing the same thing because we were seeing the same things, we were dealing with the same thing. As inflation's come down, what is remaining for most of us is really more about what's in our domestic economies. And so it's logical that we're going to diverge a bit, because what we're doing is responding to what's in our domestic economy, and that's different. And it's different for a variety of reasons that the governor's mentioned. It's different because monetary policy is working a bit differently in each economy. There's different factors. So although we were quite coordinated on the way up, and that was really helpful because a big part of inflation was global, you're going to see some divergence on the way down, and that makes sense.
Okay, next I've got Rob McClister from Mortgage Logic News. Go ahead, Rob.
Good morning. I'm wondering how Canadians should view the bank's estimated neutral rate now that we've pivoted to an easing cycle. So, in other words, if inflation evolves as the Bank of Canada projects and drops back to 2%, is it reasonable to expect the overnight rate should get close to the bank's estimated neutral rate?
Okay, well, the first thing I need to tell you is I don't think Canadians should spend a lot of time thinking about the neutral rate. The neutral rate it's a theoretical concept. It's something we need in our models. I mean, the neutral rate is, where the policy rate would settle in the long run when the output gap is closed, inflation is back to target, and there are no new shocks. In other words, we'll never get there. There's always going to be new shocks. There's always going to be new events. The interest rate is the thing that we adjust to get inflation back to target and to keep it there. Now, we do need an estimate of the neutral rate. We can't observe the neutral rate, obviously, directly. We do need to put an estimate of the neutral rate in our models. And in the spirit of transparency, we publish our estimate of the neutral rate. We updated our estimate in our last monetary policy report in April, and we increased the neutral rate estimate by 25 basis points, or we have a range. The midpoint of the range is 275. Look, I know, talk of the terminal rate, the neutral rate, I really think you're getting ahead of yourselves. If you want to know where we're headed to 2% inflation. And the interest rates are going to be what they need to be to get us there and keep us there. I mean, as we've said, look, in the near term, if the economy continues to evolve broadly as we expect, if we continue to see inflationary pressures ease, it is reasonable to expect further cuts in our policy rate. But the timing is very much going to depend on incoming data and our assessment of what that means for the path for inflation. When you look out beyond that, I mean, we don't have a crystal ball. But what we have said a few times in the past is that if you look at where interest rates were after the global financial crisis and before COVID hit, it was a period of unusually low interest rates. When you look at that today, a number of the forces that resulted in those very low interest rates look to be unwinding. So, we don't have a crystal ball, but it does seem likely that interest rates, while we do expect they're going to come down, they're probably not going to come down as low as they were pre-COVID. Or to put it another way, it would be prudent for households and businesses and governments not to plan on interest rates getting back to pre-COVID levels.
Okay, and our final question goes to Barbara Schechter from the Financial Post.
Hello, thanks for taking the call, or the question. I wanted to ask if you've modeled how far you can diverge from the Fed. Your financial stability report talked a lot about the interconnectedness of the financial markets, so you've obviously looked at that. So how far can you diverge before it starts to flow into problems with the currency in markets like the bond market, that kind of thing?
Well, I think you can. You can look over history and see how much we have diverged at various times in the past, and give you some guideline. As I said, we're not close to that. I think the market, as the senior deputy governor just indicated. Conditions are somewhat different in Canada and the United States. Inflation has been easing consistently in Canada. It's been stickier in the United States. U.S. economy has been stronger. Conditions are different. I think markets are seeing that, and that's been built into our rate expectations. It's certainly something that factored into our decision, and I think markets will continue to absorb the incoming information. So I don't think we're close to that limit. I don't think it's like there's no sort of bright line, and you can see from history there have been periods of considerable divergence.
And with that, that will conclude today's press conference. Thank you, Governor, Senior Deputy Governor, and thank you, everyone, for joining us. We'll see you in a few weeks for the NPR.